Wall Street just downgraded Homebuilders, and this is your final warning because it's worse than 2008. And I know, you probably heard it's like 2008 100 times and nothing ever happens. Trust me, we get the skepticism, but stay with me for 60 seconds because what we found when we dug into these downgrades actually made my stomach drop. 6 of the biggest home builders in America got downgraded all at once on October 7th. These companies build 1 out of every 3 new homes in this country. And when we started pulling the analyst reports and comparing them to what's actually happening inside these companies, we found 5 things that you absolutely need to know, whether you're trying to buy your first house, you already own one, or you're thinking about investing. First, there's a profit margin number that we're going to show you in just a few minutes. And when we first saw it, we literally thought it was a typo. It's collapsing faster than anything we saw during the last housing crash. That number tells you everything about where this is heading. Second, the median home price compared to median income right now, it's almost exactly where it was at the peak of 2008, right before everything came crashing down. So the big question is, why hasn't it crashed yet? What's different this time? And more importantly, how long can this possibly last? We've got the data and we'll break it down. Third, there are 2 specific states where builders are already in full panic mode. We're talking zero-down mortgages, desperate fire sale incentives, entire neighborhoods with 20-plus empty spec homes just sitting there. If you live in one of these 2 states or you're thinking about buying there, you need to stick around and find out which ones they are and what's happening on the ground right now. Fourth, Warren Buffett just made a huge move in home builder stocks last month. Now, before you think, oh, Buffett's buying, so everything must be fine, hold on. What he did actually tells you everything about the timing of this downturn and how long it could drag on, but it's not what you think. And fifth, this is the one that keeps us up at night. There's this hidden lock-in effect that's completely freezing the housing market. It's never existed before in American history, and when we explain it, you'll understand why this whole situation could last way longer than anyone's expecting. All right, let me show you what happened with these Wall Street downgrades because the details actually matter here. So on October 7th, Evercore ISI, one of the most respected research firms on Wall Street, downgraded 6 major home builders all at once. D.R. Horton, KB Home, Pulte Group, Toll Brothers, Meritage Homes, and TriPoint Homes. They moved them from outperform ratings down to in line. Now here's what caught our attention. The lead analyst, Stephen Kim, said something really revealing. He said that even though mortgage rates have fallen about 40 basis points since June, that's almost 0.5%, a meaningful demand response has not yet emerged. Let me translate. Rates went down, which should make homes more affordable and bring buyers back into the market, but people still aren't buying. That's not a supply problem, that's a demand crisis. People either can't afford homes or they're choosing not to buy even when rates improve. The stock price targets got slashed. D.R. Horton, the biggest home builder in America, got cut from $185 down to $161. That's a 12.9% reduction overnight. KB Home got hammered even worse, from $73 to $61, nearly 16.44% lower. But this isn't the first wave. Back in December 2024, Barclays downgraded D.R. Horton, Lennar, Pulte Group, and KB Home all at the same time. And that month, the iShares U.S. Home Construction ETF, basically a basket of all the major home builder stocks, plummeted 16.5%. That was the worst monthly performance since March 2020 when COVID hit. Then in September 2025, Raymond James went even further. They downgraded Lennar all the way to underperform. That's Wall Street code for sell this stock right now. So you've got multiple firms, multiple analysts, all saying the same thing over the past year. Something is seriously broken in the home building industry. All right, remember that profit margin number I told you about that I had to double check? Here it is, and buckle up. Lennar Corporation, the second largest home builder in America, just reported their third quarter results. Their gross margin collapsed to 17.5%. Now, if you're not a finance person, let me explain why this number is absolutely terrifying. Gross margin is the profit they make on each home after paying for lumber, labor, land, all the construction costs. 1 year ago, Lennar's gross margin was 22.5%. So in just 12 months, they lost 5 full percentage points of margin. That's a 500 basis point drop in a single year. We've been watching these companies for years, and we've never seen margins compressed this fast outside of a major recession. And here's the kicker. Their average selling price crashed 9% year over year from $422,000 down to $383,000. Their CEO, Stuart Miller, literally admitted in the earnings call that achieving these results required additional incentives, resulting in a reduced average sales price. Translation? They're desperate. They're slashing prices, throwing in free upgrades, offering closing cost assistance, mortgage rate buydowns, anything to get people to sign. Back in December, Lennar's CFO warned that Q1 2025 gross margins would hit 19% to 19.25%, which would have been the lowest Q1 margin in over a decade. Well, they blew right through that. They're now at 17.5%, which is even worse than their worst case scenario. D.R. Horton isn't doing much better. Their gross margin is at 21.8%, and management is openly warning that sales incentives will remain elevated and increase further during the fourth quarter. They're telling investors this is going to get worse before it gets better. Even the luxury builders are feeling it. Pulte Group's margins fell from 29.9% to 27%. Toll Brothers, they build $500,000 homes, went from 27.4% down to 25.6%. When even the luxury market is getting squeezed, you know something fundamental is broken. Welcome to Econofin, a team of 5 professionals bringing you smart insights into real estate markets, investments, and strategies, turning knowledge into opportunity. If you're finding this valuable so far, please take 2 seconds to hit that like button and subscribe. Every like and subscription helps support this channel and keeps us motivated to dig through all this data and bring you the real story. We really appreciate it. Now, let me show you the data that explains why this is happening. The National Association of Homebuilders just released a study that found 74.9% of U.S. households, that's 100.6 million American families, cannot afford a median-priced new home at $459,826. Think about that. 3 out of every 4 American families are completely priced out of buying a house right now. Here are the numbers. Median home price is $435,300. Median household income is $83,150. That's a price-to-income ratio of 5. Now here's the historical context. In 1985, that ratio was 3.5. For decades, financial advisors said the standard of affordability was around 3 times your income. If you're buying a house that costs more than 3 times your annual salary, you're stretching too far. We're now at 5 times income, 67% above the traditional standard. But here's the comparison that should make your jaw drop. In 2006, at the absolute peak of the housing bubble, right before the entire financial system nearly collapsed in 2008, the price-to-income ratio was 5.4. We're at 5 right now. Some analysts are calculating it as high as 6 times income for 2024. The NAR Housing Affordability Index fell below 100 for the first time ever in June 2025, hitting 94.4. An index below 100 means the typical American family literally does not earn enough to qualify for a mortgage on a median-priced home, even with 20% down. Let me make this really concrete. The median monthly mortgage payment right now is $2,750. To afford that under standard lending guidelines, where you're spending about 28% of your gross income on housing, you need to earn between $126,700 and $141,366 per year. But the median household income is only $83,150. There's a $43,000 to $58,000 gap between what you need to earn and what the typical American family actually makes. That gap? That's the crisis. And it's not just monthly payments. If you're a first-time buyer putting 3.5% down, the FHA minimum, you need $14,438 for the down payment, plus another $12,000 plus in closing costs. That's $26,800 cash just to walk through the door. If you're making $50,000 a year and saving 10%, it would take you over 5 years to save that much, assuming you never have a single emergency expense, no car repairs, no medical bills, nothing. That's the reality. Here's where it gets even more brutal. The mortgage rejection rate nearly doubled in 1 year, from 12.1% in 2023 to 20.7% in 2024. That's a 71% increase in rejections. And the number one reason people are getting rejected? Debt-to-income ratios that are too high. They simply have too much debt relative to their income. Debt-to-income ratios for Ginnie Mae loans, those are FHA and VA mortgages, typically used by first-time buyers and veterans, hit 45.1%. That's the highest level since 2008. These buyers are stretching themselves to the absolute limit. Student loan debt is crushing the next generation. 37% of first-time buyers are carrying student debt with an average balance of $38,787. Research shows that every $1,000 increase in student debt lowers the home ownership rate by 1.8 percentage points. The first-time buyer market has completely collapsed. In the 12 months ending June 2024, first-time buyers made up only 24% of all home purchases. That's the lowest in the National Association of Realtors' 43-year history of tracking this. The long-term average is 38%. And check this out. The median age of a first-time buyer is now 38 years old. That's the oldest it's been since NAR started tracking in 1981. In the 80s, the typical first-time buyer was in their late 20s. An entire decade of wealth building through home ownership has been stolen from younger Americans. 10 years of building equity, 10 years of locking in a fixed payment while rents increase, 10 years of tax deductions, all gone. Remember I mentioned there's this bizarre lock-in effect that's never existed before? Here's what's happening, and it's wild. Over 80% of homeowners have mortgage rates below 5%. About 65% have rates below 4%. Locked in during that 2020-2021 refinancing boom when rates hit historic lows. Current 30-year mortgage rates are around 6.3 to 6.4% right now. So here's the problem. If you have a 3% mortgage on a $400,000 home, your principal and interest payment is about $1,686 a month. If you sell that house and buy another $400,000 home at today's 6.4% rate, your payment jumps to $2,505 per month. That's an $819 per month increase, almost $10,000 more per year, just to move to the same priced house. So people who would normally move for a job, to upsize for a growing family, to downsize and retirement, they're staying put. They literally can't afford to give up their low mortgage rate. That's why existing home sales dropped to a 30-year low in 2024. The market is frozen. Builders thought they could take advantage of this by building new homes, but they're running into the same affordability wall. New home sales did jump 15.4% year over year in August 2025 to 800,000 units, but back in 2005, new home sales were running at 1.28 million. We're still 38% below those levels. And here's the problem. Builders are sitting on massive inventory. Month supply of new homes hit 7.4 months in August 2025. It peaked at 9.8 months in June. Anything above 6 months is considered oversupply. They've got 490,000 homes for sale, and many are completed spec homes that just aren't moving. This lock-in effect means this situation could drag on for years, until rates come way down or until life circumstances force people to move. It's unprecedented. All right, remember I said there are 2 specific states where builders are in full panic mode? Here they are: Florida and Texas. Florida started 2025 with 172,000 homes listed for sale, up 22.7% year over year. That's the highest inventory level in a decade. If you drive through new developments in Florida right now, you'll see things you haven't seen since 2008. Builders advertising zero-down mortgages, rent-to-own deals, and entire communities with 20-plus vacant spec homes just sitting there. Texas is showing the same stress. Both states went on a building spree during the pandemic when people were fleeing high-tax states like California and New York. Now they're massively oversupplied just as demand is cooling. Lennar specifically called out these markets. They're spending 13% of their revenue on sales incentives right now. Mortgage rate buydowns, closing cost assistance, straight price cuts, everything. When a builder is spending $1 out of every $7.69 in revenue just on incentives to get people to buy, that's desperation. And here's why this matters if you don't live in Florida or Texas. This regional stress is exactly how 2008 started. It began in the Sand States, California, Nevada, Arizona, and Florida, where overbuilding created a glut. Then it spread. I'm not saying we'll see a 2008-style nationwide collapse, and I'll explain why in a second, but these regional warning signs shouldn't be ignored. The NAHB Housing Market Index, which measures builder confidence, has been below 50 for 16 consecutive months. Below 50 means more builders view conditions as poor than good. In September 2025, it was sitting at 32. For perspective, at the pandemic housing boom peak in November 2020, builder confidence was at 90. It's now 64% lower. In June 2025, 37% of builders were cutting prices. By August, 66% were using sales incentives. When 2/3 of builders are offering deals just to get people in the door, demand is pretty weak. Okay, remember I said affordability is worse than 2008, but we haven't seen a crash yet? Let me explain what's different because this is crucial to understand. The lending standards today are completely different. In 2006, 1/3 of all mortgages were subprime or non-documentation loans. People with terrible credit got $500,000 mortgages with zero down and no proof of income. In 2024, only 1.2% of mortgages are subprime. The average FICO score for new mortgages is 715. The median credit score is 772. These are the highest credit quality borrowers in history. Foreclosure rates are 85% below 2008 levels. Right now, it's 0.066%. That's 1 in 1,515 homes. In 2008, it peaked at 1.8%. Mortgage delinquency is 2.3% compared to 9 to 14% during 2008-2009. Homeowners have record equity levels. Total tappable equity is $6.3 trillion. In 2008, millions were underwater, owing more than their homes were worth. Today, 59.7% of homes are owned free and clear with no mortgage. The inventory situation is also fundamentally different. In 2008, we had 13-month supply and massive overbuilding with 2.2 million housing starts per year. Today, we're at 1.1 million after a decade of underbuilding, creating a structural shortage of 2 to 7 million units. So we're probably not going to see a 2008-style crash with 30 to 40% price drops nationwide, but we could see a prolonged period of flat to slightly declining prices, especially in overbuilt markets. And builders will keep struggling with margins until rates drop significantly or prices adjust. All right, here's what Buffett did and why it matters for your timing. In August 2025, Berkshire Hathaway took new positions in both D.R. Horton and Lennar. When Buffett makes a move, everyone pays attention, but here's what you must understand. Buffett invests with a 10-year time horizon, maybe longer. He's not looking at next quarter or even next year. He's looking at where these companies will be in a decade. His bet is they'll be much more valuable than today, even if they struggle for the next year or two. That tells you the long-term fundamentals are intact. Eventually, rates normalize, affordability improves, and these companies make money again. But if you're a short-term trader or need money in the next couple of years, these stocks could have more downside first. Buffett can wait 10 years. Can you? Let's get practical. If you're thinking about buying a home, this is not 2006 where you had to buy now or be priced out forever. Builder incentives are increasing. Inventory is building. In 50 top metro areas, renting is $908 per month cheaper than buying a starter home. Unless you're staying 7 to 10 years minimum, renting may actually be smarter financially. If you're looking at Florida or Texas specifically, be extremely cautious. Wait for more price discovery. Those markets haven't bottomed yet. For investors and current homeowners, we're unlikely to see a 2008-style crash, but expect flat to slightly declining prices, especially in overbuilt areas. Homebuilder stocks trade at depressed valuations. D.R. Horton is down 16.3% from its 52-week high. Strong balance sheets, but challenging near-term margins. Wall Street's signal is clear. Home building is in trouble. Margins collapsing, demand weak despite falling rates, affordability at crisis levels exceeding 2008. 75% of Americans can't afford a median-priced home. First-time buyers are just 24% of the market. Builder confidence negative for 16 months. Mortgage rejections nearly doubled. This isn't 2008 with millions of foreclosures. Credit quality's too strong. But in pure affordability, this is worse. And we haven't seen the correction yet. If you're buying, be patient. If you're investing, expect several quarters of weak fundamentals. If you're a current homeowner, appreciate your equity and low rate. Don't give it up unless necessary. The next 12 to 24 months are critical. Make decisions based on data, not emotions. In distorted markets, discipline and patience win. Thanks for watching. Hit subscribe for updates and comment below, buying, selling, or waiting. We want to hear from you.